before we get to top picks, we'll squeeze in one more email question. LVO is asking about Capital Power, CPX. Is this a good stock if you want to play renewable energy?
This is a stock that's done incredibly well. I took off these merchant power companies from my watch list for a while as we went to more regulated plays, but it's done really well. Not surprising with all the activity that we're seeing out west. I wouldn't really say it's a great renewable play per se, but it's a company that's going to have a lot of exposure to rising power prices. So I think you have to make the decision of whether you want to own this stock now after it's sort of generated a whole bunch of extra revenue in the last little period, and dividend yields about 4.5%, or whether you want to look at more traditional renewable plays, actually have a higher dividend yield like an Algonquin Power or something like that we talked about. So I would probably, depending on your risk profile, I'd probably steer you towards the latter. It's going to be less volatile. You'll get a higher yield, and it actually has a little bit more renewable exposure. So that would be my recommendation there. But CPX has certainly done well.
Okay, well, let's get to the top picks. Your first idea is Celanese, a big player in chemicals.
Yeah, so Celanese, it's interesting. What I love about the team here at Aventine is every once in a while we zoom out. Not every once, we often zoom out and we look at multi-year opportunities. And this is a name that we've kicked around for a little while, and we finally thought it was time just recently to add it as a position to our Aventine dividend fund. And so it's a large chemical company. If you go on their website and you check out what they do, they're basically involved in everything from on the medical side to the consumer side to the energy side to the paint side. They're in every industry that you can think of, whether it's an acid or a pigment or some kind of chemical. And it's trading at, if you looked, it's quite ridiculous at about 6.5 times earnings. So it's really sold off here as there's been this global growth scare. But what we view as the opportunity here is that they're generating close to $1 billion, over $1 billion in free cash flow. They're deleveraging their balance sheet in a rapid fashion after they're swallowing an asset from DuPont called M&M. And so that's caused a little bit of nervousness around the stock, and it's caused the multiple to trade at a level that we've never seen before. So if you can think multi-year and get that there's going to be a little bit of volatility around the GDP style growth that they have in the business, investors are going to be well rewarded with A, dividend growth, and B, rapid deleveraging and potentially more deals down the road after they take M&M inside their business, which, by the way, diversifies their business as well. We also noticed on the 13Fs that Warren Buffett was buying this stock as well. So that's kind of nice when you see that.
WSP Global is your next idea. The engineering consulting company has been doing a lot of acquisitions.
Yeah, this is a company that we've followed for years. And when it had its most recent sell-off in 2022, we just rolled up our sleeves and we wanted to get involved in understanding the business a little bit more. We've been very impressed with this management team and how they've been able to integrate these businesses and generate above stated synergies, which is actually quite impressive given the amount of deals that they've done. And it got down to a valuation level that we thought was fantastic. And about a week later, they announced this John Wood acquisition. And that was the catalyst for us to say, yeah, it's time to add this to our core equity strategy for our clients. We love this environmental water space. All the engineers, architects we speak to on the private side and the public side, it's a huge part of the conversation, and we think it's going to be a big driver for them going forward. It's about 40% of their product mix or revenue mix comes from those areas. So that's going to be a great tailwind for them as we in the next few years. And at this valuation level, it's very reasonable. Be patient with it. It sort of has run up, but it's a great name to own for the long term, and we feel more encouraged by it after these last few deals.
And finally, Park Lawn, the funeral services company. The death rate is down post the height of the COVID pandemic, and that depressed their results lately. Sorry, go on, James.
No, it did, absolutely, and you're right. And it is a bit of a contrarian play right now, but one of the things we love about Park Lawn is that you don't have to think short term with this company. So when we got involved in this company years ago, they had stated objectives. They're going to do a certain amount of acquisitions. We know it's a very fragmented industry as they're buying funeral homes, both standalone, but also the larger ones that have cemeteries, funeral homes in multiple locations. And we just think they're going to continue that drumbeat of doing these deals. And so we have no reason to believe they won't. So in the short term, yeah, there's going to be some tough comps, maybe this quarter, maybe next quarter. But we think once we get back to a normalized level, investors are going to go back to enjoying the free cash flow they generate, enjoying the inorganic growth that they get, and who knows, maybe they announce a couple of big deals. One of the things we love about this management team is how they talk about their acquisition pipeline. It's companies want to do business with them. There's some private equity players and other public players that are consolidating this space as well. But Park Lawn has a great reputation out there to work with. They keep the brand, and we think that's going to allow them to be an industry leader here in the space. And they've got the balance sheet to do it as well, and they've got our support as investors. So we think now is a good time to focus on the long term and add a position of Park Lawn if you don't add it already. It's a small dividend too.
It's interesting as well. I gather from research that in the latest quarter, what worried investors was a drop in pre-need buying. I think that's where people buy a grave in advance.
Yeah, exactly. So you can imagine that's a big margin business, right? There's not much you have to do to get that business, and it's a sales pipeline job. So you try to sell these. So what they stated on their call was that there was a few larger cemeteries that that impacted that greater than anything else. It wasn't a systemic problem. It was just some deals that slipped. Some people are traveling, they're going on their Carnival cruises or going to Disney, and they're not thinking about buying a plot, which is probably a good thing. But we'll get to a normalized level after we lap some of these next few quarters. So it's not something that we're overly concerned with at this point. It's the sort of business that's somewhat in recession proof, and so we think it's a good one for the long term.